Hi, my name is Alex Carlucci with Gustan Associates. I'm going to talk to you about the tax laws that went into effect this year. So, in the past, if you had a mortgage, you could take all that interest that you paid in that mortgage during the year and deduct it right off of your income and get a refund if you're W-2'd because you overpaid taxes. Because what it does is it takes the interest that you paid in the mortgage over the year. Let's just say it's $12,000. That's like $1,000 a month in interest, part of the principal and interest payment. That $12,000 you should never have been taxed on by the government. So they take that off, and then you should have only been taxed on that new number, and whatever that tax liability is minus what you actually paid, you get a refund for. So on a $12,000 tax deduction, you'll get about $3 grand back, maybe $4, depending on the other write-offs. So they made a change to that rule. Mortgages above $750,000 are no longer eligible for any mortgage interest deduction. So that doesn't hurt most of you, but it changes the way the demand curve is going to work for houses. People would buy homes for tax deductions. That might affect people buying houses for $750,000, the investors, whatever. It could affect anything that part of this mortgage industry, because now there's less money that wants to go after mortgages. Now, there's also another change that they did, is this will affect some of you, a lot more of you, is you used to be able to deduct all the taxes you paid in property taxes. Some of you guys have $14,000 of your taxes. Well, you could deduct that off your income also. Well, they've capped that at $10,000. So with that cap, there's less deductions, less write-offs, but the good news is the government increased the standard deduction. So if you never had any write-offs, now all of a sudden you got a nice high standard deduction. So there's different tiers. So if you're single, you get $12,000. If you're filing a household, you get $18,000. If you're married, you get $24,000. So it affects your deductions, because if you can't get to that $24,000 as a married couple using your itemized deductions, the mortgage interest write-off is defeated a little bit. So I want you to know that mortgage interest deductions have become less important in buying a house. So if you also used to write off unreimbursed expenses for your business, like a car, there's a little thing, gas, mileage, you no longer get to deduct these unreimbursed expenses off of your W-2 income anymore. So there's a lot of things changing that change the way that deductions for mortgages have really hurt the mortgage industry. It hasn't really helped, so it's a negative impact on the mortgage deduction part. But it doesn't really hurt you individually, because they made up for it in another way. So buying that house and using that mortgage deduction isn't as powerful as it used to be. It used to be really a necessity for people to survive, because that extra $4 grand in your pocket they used to get because you bought a house versus renting has been diminished a lot. And the people who have high property taxes, you've been affected. The people buying large homes, you've been affected. So keep that in mind. Those are the new rules changes for taxes and write-offs. And I hope you like this video. Please go to gustanshow.com, GUSTANCHO.com, or call me. I'll talk to you about this, 630-915-7550. Thank you.